Hey, what's up, everybody? It's Friday. Yeah, July 15th. Nice day in the markets today. But before I get started, I want to thank everybody who left their condolences. I really appreciate it. Yesterday was rough, man. If you didn't watch my video, I lost my dog. My dog died. She was 15 years old. She was sick, and it's just a heartbreaker because, you know, my dog was my best friend. So anyone who is a dog owner, I'm sure you can appreciate what I'm saying. And if you lost a pet, I'm sure you can absolutely appreciate what I said in that video. Anyway, let's get to it. We had a good day today. Market's up strong. Now there's some numbers that look pretty promising, I have to say, because I just went over the fiscal numbers, and I'm gonna cheat here a little bit because I got my little whiteboard. But anyway, first I want to start off by saying, you know, I've been talking a lot about how we had that big April tax drain of 324 billion, and you know, we're into mid-July now, and we still haven't made all that back. Like that tax drain. And that might have been a record. That tax drain in April, that set us back a lot. I mean, if you go back to mid-April, the market was stabilizing. And at that time, I wasn't even calling for negative second quarter GDP. But that drain really, you know, sucked a lot of the wind out of the markets and the economy. And, you know, we've been struggling since then. But, you know, the market has found its footing. And I've been telling you guys that, you know, so we had the 86 billion deficit in May, which was followed by a 54 billion deficit in June. And so far in July, we have a 132 billion deficit. That's great. So the 3 months combined now, we're at a cumulative 272 billion deficit. In other words, swimming pool analogy, if 324 billion was drained out, completely drained out, 272 billion of, you know, water volume was pumped back in. So now the level is just 52 billion below where we were prior to that April tax drain. So that's good. I mean, we got back a lot of what was drained out. We're very close to being back to that level, okay? That is a positive thing. Now, the deficit right now is at 845 billion. That's the cumulative deficit for the fiscal year. 845 billion, that is the largest deficit since April 14th. Why is this important? Because April 14th was right before that massive, you know, tax filing that drained everything out. So we have, you know, looking at it on a cumulative basis, like where do we stand? We're back. We're back to where that swimming pool was before the April tax drain. So that's really good. Here's another statistic that might interest you. The deficit right now as a percentage of GDP is 3.47% of GDP. Why is this important? 3.47% of GDP exceeds the deficit expressed as a percentage of GDP that we hit on June 9th. That was the prior, you know, we came down big from the April tax drain. Then we started coming back up. Then we took another hit. Remember, it was that we had that what was it? I think it was the May. Or was it June? It was the June. Yeah, the June corporate quarterly tax drain. Okay, but now 3.4% of GDP, the deficit. That's bigger as a percentage. When you express it as a percentage of GDP, that's bigger than the one we saw in June 9th. Why is June 9th an important date? Not just because that was the prior little peak in the deficit, but that week of June, like the 6th, 7th, 8th, and 9th, we had consecutive tops in the market. Like it couldn't break through there. it couldn't break through there, and it was a good reason why it couldn't break through there. We were about to get another big tax drain from that corporate tax payment, but now we have surpassed that. So I am going on record right now to say that the stock market will rally above the June 9th highs, okay? If you are short, if you have any kind of defensive position on, I would exit that immediately on Monday, and I would flip to an aggressive long, bullish position. We are going to take out that June 9th, and then we'll see what happens with the fiscal. But as you know, I've been telling you guys that, everything was fiscal wise, everything was looking good at least until mid-September. And I also said that August, remember August next month, that's like, August 15th, we'll get a quarterly interest payment of like 45 billion. So like the rest of this month and then through August, that should be powerful. By the way, the 10-day average of daily spending flows right now is 30.3 billion. That comes to a 607 billion monthly flow. So all these numbers look good, man. They look really, really good and positive. And I would definitely, if we get pullbacks in this market during the day, you want to abandon your short positions. You want to cover those. You want to flip around to an aggressive long posture. This should probably be good for commodity prices. It should, it should be good for gold. It should be good for silver. We should definitely see a continued bounce in oil. By the way, I think I mentioned yesterday. Oh, I didn't do the video yesterday, right, because of what happened. But the other day, I might have done it the other day. I don't remember. No, but I did send out an email to my subscribers that that 91 something we hit on WTI on oil, that just looked too good to be true in terms of a buying opportunity. And I think we closed today near 98 or 97 and a half. The only thing I would say is that, Biden is over there in Saudi Arabia. He's meeting with MBS. The people I listen to who are, they are pros in the oil business. And I'm not talking about these are not like fund traders who are looking at charts. These are people in the oil business who really have their ear to the ground and know what's going on in the physical market. They're telling me that they do not expect any kind of an output increase deal, especially not unilaterally from Saudi Arabia. If it's an OPEC plus collective deal, and even that is questionable because certain entities within OPEC plus, certain countries like the UAE, they're running right now at like maximum output, and it's even questionable how much the Saudis can increase. So it doesn't look likely. However, I will say this. If Biden does manage to get MBS, to get the Saudis on board with an increase, even if that's just a headline announcement, and I think that's all that it would really amount to. But a headline announcement, I will say this, will cause another spike down in oil. We'll see that next week. But the sustainability or the ability to bring on enough oil to alleviate the market tightness right now, even if the Saudis, give like a token increase, to, I don't know, to get something, a quid pro quo from Biden. Maybe he's promising more fighter jets or whatever. I have no idea. But if that happens, it would be a headline trade, and I think you'd see a pullback next week. But I don't see that as something sustainable, especially as we get into the fall and the winter. That's when I think we're really going to see some very interesting energy markets. So the good news is, I think we're out of the woods in terms of fiscal. The numbers really look positive right now, especially I'm really happy to see that the deficit rebounded back to 845 billion. That is the high, again, swimming pool analogy. The water's back to where it was prior to the April 18th tax drain. That's excellent. And it's only going to get better because we got the rest of this month, and we have the month of August, again, with that quarterly interest payment. So things are looking really good. We saw today, and by the way, I don't know if you caught this, but yesterday, Fed Fund futures started pricing in a 100 basis point increase in the policy rate for the July 27th meeting. There was a big panic yesterday because of that record inflation print, but today it dropped down again, and the expectation, the probability based on where Fed Fund futures are trading, that's looking more like a 75 basis point hike is what we're going to get at the July 27th meeting. But you know, that stuff could change. I mean, it changed dramatically from yesterday, from the day before yesterday to today. What else can I? Oh, the euro. So the euro, of course, we traded down yesterday to, I think we got down to a 0.9952. That's euro versus dollar. So 99.5 cents. Today we were back up to like a penny. A penny 0.008. So we're back over parity, but just by a little. Next week we have an ECB meeting. They're gonna raise rates. It's expected a 25 basis point rate hike. I think that's going to be the first rate hike in 14 years for the ECB. We'll probably see a little pop higher in the euro after that, right? You know, immediately following that rate hike, but then that's a sale. You want to sell into that. No doubt we can get some short covering here. The euro is very short right now, speculative wise, but you know, policy wise, I just don't see anything right now that's going to be supporting the euro. You still have major energy issues in Europe, in Germany, and that only is going to intensify as we get into the fall and into the winter. So that's the wrap up for today, folks. Bond market was a little bit higher. Yields were down a little bit. There were some comments. I forget who made the, I don't know if it was Bullard. One of the FOMC people today said, hey, you know what? Inflation looks like it's coming down. And actually, when he said that, that's when we got a big pop higher in the market. And that's when Fed Fund futures started to really reduce the expectation of a 100 basis point rate hike on July 27th. So, you know, that you want to see statements like that. I mean, if you're looking for a bond market rally, you want to see statements to the effect like the Fed starting to temper their policy outlook, temper their rate hike outlook. So that was something that popped up today. All right, everybody. I hope you had a great day. Enjoy your Friday. I'll try to do a video over the weekend. Take care. Bye.